We have discussed about what are fixed assets, what is the significance of fixed assets in business, and why do businesses have to maintain fixed assets separately, and how depreciation works on fixed assets. Then we have discussed about different types of fixed assets in business, then the different depreciation methods and different depreciation methods offered by Dynamics for depreciating fixed assets. So we also discussed about how to create depreciation profiles using such depreciation methods. After that, we discussed about fixed asset groups. So fixed asset groups are something how you can group your fixed asset depending upon their nature or or about the similarity of the assets that they carry or according to the depreciation methods that they follow for the set of assets in business. So it could be the requirement of the business how to group their fixed assets. So accordingly, you can create fixed asset groups. In our system also, we have created fixed asset groups like vehicles group, and we can see that in fixed assets under setup. Here only we have everything, depreciation profiles, fixed asset groups as well. Here in the fixed asset groups. So we have created two fixed asset group, fixed assets furniture and fixed assets vehicle. So we have discussed about the menu details within them as well. So today's topic to be discussed is books. Very, very important topic, and wherever you go in interview, they would definitely ask you this question. What are books in fixed assets? So let us discuss this part of books in fixed assets. So books is a specific configuration in fixed assets. So which would define the how asset have to perform. So book have everything. Book have uh, the acquisition value or the salvage value or the scrap value or when the asset is acquired, what is the placed in service of the asset, and then the details of depreciation. Everything is linked in the books only, the concept of books. So every fixed asset, if it has to undergo with depreciation or has to be maintained, or if either you have to post in any transaction on the fixed asset, it should be linked with book. So book have all the key elements of a fixed asset. Book contains all the key elements of a fixed asset like acquisition price, acquisition date, and depreciation profiles which are mapped for the fixed asset and other financial dimensions that are related to the fixed asset. Okay. So I can note down or write down some generic definition of books which you can explain in the interview. Books configuration contains the key elements of a fixed asset like acquisition value, date, salvage value, or this scrap value. What else we have? Depreciation profiles, dimensions. So we can maintain different books in business. Actually, I'll come back to that point. So actually, a fixed asset can be maintained in multiple ways in a business. So according to India, let's go for the example of Indian business structure. A fixed asset is maintained under two different acts. One is according to the rules and regulations of Companies Act. Another one is according to the rules and regulations of Tax Act, or you can say IT Act, Income Tax Act, or so Companies Act and Tax Act. And they both have different rules and regulations for the businesses to maintain their fixed assets in this particular manner or this particular manner. Okay. The Companies Act generally suggests the business to maintain the straight line service life method for all the fixed assets that they have in business. Whereas it comes to Tax Act would suggest the businesses to maintain the reducing balance method according to different slab rates depending upon the nature of the business. So when it comes to straight line method, there won't be any slab rate. Straight line method is something where the asset where net book value is divided by the number of service periods or service life, number of service years of the asset, and accordingly the depreciation will be evaluated. So it would be the common for any asset regardless of the nature of the asset. Whereas it comes to Tax Act comes with different rules or set of rules where depreciation on fixed asset has to be maintained with a different slab rates under reducing balance method. So how can we maintain a single fixed asset in multiple ways? So we can do that. In Dynamics, we have that flexibility to maintain a single fixed asset in multiple ways. So one which is maintained under Companies Act is the main book, and it would affect the original accounts books. The remaining books that we maintain, additional books like Tax Act book or any other additional books, are just maintained, but the effect will not be shown in the financials in the current layer to say exactly. So we'll come back to that point of layers and all. But as I was saying that there will be lot of books in business or a fixed asset will be maintained in multiple ways. So books also help business to maintain fixed assets in multiple ways. So how do we maintain fixed assets in multiple ways? What is the importance? We'll see in the I mean, further explanation. Before to that, as I was saying in India that we have Companies Act and Tax Act, whereas it comes to other countries, they have their IFRS gap. According to the IFRS gap, generally accepted accounting principles, they maintain, or according to IFRS guidelines, they maintain assets separately or in one particular pattern, or according to the local gaps they have to maintain the fixed assets in a different way. So the acquisition value of the fixed asset will not differ in any of the book. It will be the same, but either the tax amount has to be capitalized or not, and the depreciation methods to be followed and how the asset has to be depreciated. So that will be differing from gap to gap or act to act. So according to each and every act, we can maintain a fixed asset in multiple ways, but one will be the main and important one, which would be affecting the original books of accounts. The others are just dummy maintenance. It would We can generate reports out of system for maintaining them, and we can provide the reports to the concerned authorities. So just for that maintenance sake, we would maintain those dummy layers or the other dummy books to maintain a fixed asset in multiple ways. So it may be according to the different acts in the country or maybe according to the different gap IDs that are followed. So a fixed asset could be maintained. So how to configure the books concept we'll see now. Okay, I'll just go to fixed assets again. Everything is under setup only in fixed assets. Most of the configurations are here. Depreciation profiles are here. Fixed asset groups are here. Books are here. Fixed asset posting profile is also here. So let me go to books here. So this page is empty since we do not have any books created. We can create a new book. So here you can create a book. So what do you want to name this book as? So I'll just name it as CA book, Companies Act book. So you have certain parameters here, which we would discuss now. Calculate depreciation. Either depreciation has to be calculated or not. So the whole purpose of maintaining a book is that we have to guide the assets to be depreciated, or the depreciation has to be maintained on fixed assets. So you can say by default that calculate depreciation. Again, this configuration is a generic configuration which you can use for many books at a time. For each book, if you want to stop calculating depreciation, you can disable this parameter in books in assets separately for each fixed asset. Okay, this one here which you give is just for the default sake. So by default it would be calculating the depreciation. Then you can give a depreciation profile for a fixed asset, or can maintain one depreciation profile like this one, straight line service life method. On a single fixed asset within a single book, you can also maintain an alternative depreciation profile. So what happens if you maintain an alternative depreciation profile? Suppose let's say I'm taking this depreciation profile as an alternative depreciation profile, or I'll take this one 150% reducing balance as an alternative depreciation profile. No, okay, in this one I did not give year one. Let me give a second. Calendar monthly. Okay. Calendar monthly. Okay. Same depreciation year and period frequency. Same only, right? We have given. Something wrong. 50%. Okay. Here we have yearly. Just save it. Kept calendar monthly. Now it should accept after refreshing. Okay. So we can give two depreciation profiles within a single book as well. What happens if we give two depreciation profiles is, out of these two depreciation profiles, system would calculate two different depreciations using this depreciation method as well as this depreciation method. So in both of the methods, whichever method calculates higher depreciation in that particular month, so that higher value of depreciation will be selected by the system for depreciating the fixed asset for that month. So if you give two depreciation profiles, not most of them would go for two depreciation profiles within a single book. But if you go with two depreciation profiles, out of the two depreciation profiles applying on the net book value of the fixed asset, whichever depreciation profile calculates the depreciation value more, so according to that, the depreciation value will be picked. Okay, for that particular period, according to that depreciation profile in which the depreciation calculated is more, so that will be picked. Keep that logic in mind. We'll further also discuss about this point when the situation arises. Okay, it's not mandatory that you have to maintain two depreciation methods, and none of them would maintain them except when they have a need to maintain two depreciation profiles. Okay, within a single book also you can maintain. I'll just remove it here as of now. But when the example has to be shown practically, wherein we create a fixed asset and apply other values, I'll show you clearly. You can also apply an extraordinary depreciation profile. This is only for the extraordinary situations. Extraordinary situations in the sense, if there is a natural calamity and there is a unforeseen loss or damage in the fixed asset. Suppose if there is a factory and if there is a cyclone and the factory got damaged, that value of damage you can depreciate by using the depreciation profile or extraordinary depreciation profile, which is applicable for the extraordinary situations. Under extraordinary depreciation profile, you could not give any of these methods or any of these depreciation profiles which we have configured. You only have one alternative, which is called as manual depreciation profile. So you can create a manual depreciation profile actually, like according to your uh, requirement. So here you have one method called as manual. So manual is a method where you can give your own depreciations. So suppose if you can give yearly or monthly anything, so you can give your own depreciation schedules. So first year 30%, second year 50%, third year remaining 20%. You can give it like this if you want to. So calendar yearly you have given, right? Or you can give monthly and divide 12 periods. So for each month, you can give the amount of depreciation that you want. So this method will give you the flexibility to maintain your own depreciations rather than following any standard methods. So that is also available, but not most of them will follow this depreciation until and unless they have to depreciate a fixed asset using this extraordinary depreciation profile. See, suppose if I select any other method here, like this 200% reducing balance, it won't accept. It says Extraordinary depreciation is allowed only for depreciation method manual. If you select manual method, then only it would agree. Otherwise, it won't accept any other depreciation profile. See. So as I was saying, this is only for the extraordinary situations where you have to depreciate a fixed asset irregularly according to any of the extraordinary situations where you causes any damage like cyclones or any accidents in business, any short circuit or failures kind of accidents accordingly. Then round off depreciation, you can round off the depreciation on fixed assets according to the nearest cents, like the nearest 10 cents, or you can say like directly to $1. Always it will be in one, it will be rounded off to nearest dollar, either backwards or forward, depending upon the half amount. So or else you can keep it as 0, 0 so that all the fractions are also calculated. I mean, the after two decimals also calculated here in the after point also calculated or evaluated and represented. So you can also use this leave netbook value at means you can give a direct scrap value something like 1000. So whenever the netbook value of the asset comes to 1000, it will stop calculating depreciation. It will not calculate depreciation on that 1000. May it be any asset which is linked to this particular book. So it won't calculate depreciation further after this 1000. So when the netbook value arrives at 1000 value, so further it won't calculate depreciation. You can give such value or you can leave it for each specific asset. You can give netbook scrap value if you want to. Then you have this one, create depreciation adjustments with basis adjustments. This is a situation where you have acquired a fixed asset, let's say suppose on 1st of January 2022, and you have depreciated it for until June 30, 2022. Let's say like you are at the date of June 30, 2022, and you depreciated the asset completely for the 6 months from starting from the 1st of January. And in between, you have added something to the fixed asset, actually, but you forgot to post an acquisition adjustment entry or addition entry to the fixed asset. Suppose something has to be added in the March. You bought something as an addition to the fixed asset in the month of March, but you forgot to add it in the month of March. In that case, if you are going to add it for the month of March once again, maybe you are just sitting in the month of June, but you are making an adjustment entry for the month of March, like acquisition adjustment entry, which adds value to the asset. But when you see from March to June, you also need to calculate depreciation on the addition amount which you are adding to the fixed asset. So in that case, if you are making any such past adjustments in the acquisition value of the fixed asset, does it also have to adjust the depreciation or not? That's what this parameter is asking. So create depreciation adjustments with basis adjustments. In case if you are making any adjustments to the fixed assets net book value or the acquisition value, so if you want to make any depreciation adjustments according to that increase in the value, so this would be the key parameter which you have to enable. Or if you don't have such rules, you don't have to enable this one. But mostly they will have that depreciation calculation also on the additional value of the fixed asset, whatever is added to it in the meanwhile of the service life of the fixed asset. So post to general ledger is one we have. Generally for only this book or only for this book or the other book also we can maintain. I'll show you. If you don't use this option post to general ledger, adjustments or the transactions are posted to the fixed asset in the fixed asset module, but the vouchers are not posted into the general ledger module. If you disable this parameter, adjustment entries or the vouchers are not posted to general ledger but are posted on fixed asset. The values on fixed asset will be adjusted accordingly with the transaction that you post, but the vouchers will not get posted into general ledger or will not impact the trial balance. This is disabled for certain books which you don't want to post any transactions to general ledger, like dummy books as I told you, and you don't have to, what to say, we can select that. I mean, if you don't want to post and just maintain the fixed asset, that's all. Don't want to post any transactions further into general ledger, then you can disable this parameter. Otherwise, you can enable this one. And you see the posting layer here as current. If you disable this, you don't see any posting layer. It will show none. But if you enable this, you see this layer default as current layer. Current layer is the main layer in which the original books of accounts are maintained. So every transaction that we posted until now is posted into current layer only. Other than current layer, we have multiple layers like operations layer, tax layer, custom layer, and seven other custom layers, total 10 layers. So why are these layers here, or what is the significance of these layers? In every journal name that we created, there is a posting layer called as current. If you want, I'll just show you. So these layers are mostly useful here in the fixed asset module only. So if I create another book and use this tax layer, the balances will be posted into tax layer separately. That will not affect current layer. Suppose if I walk you through this layers concept once again. So in general ledger module, well, we created the journal names here. We have created multiple journals until we'll further also create some fixed asset journals. Suppose let's see this one allocation journal. Here we have this layer, posting layer as current layer. Not only that, suppose if you see general ledger, journal journal, see posting layer is current layer. Intercompany journal, posting layer is current layer. Vendor invoice journal, posting layer is current layer. Vendor payment journal also posting layer is current layer. So we also have this 10 layers, but still we are using the current layer because that is the main layer in which the original books of accounts or the balances are posted and maintained. The other layers are just I mean, you can post other transactions also into these layers, but they're only for the dummy sake or maintenance sake. So in order to maintain fixed asset, this would be useful. If you want to maintain fixed assets in multiple books, you cannot maintain multiple books with the same posting layer as current because that will post double impacts into the current layer or into the books of accounts. So that is why for each book they will use separate posting layer. Sometimes they don't post it to general ledger at all, then the posting layer will be none. So either they can use different posting layers for each book separately. Suppose if I go to trial balance, for example, general ledger trial balance, we know already. We have been to this page a lot of times where we can see the total balances. So here I'm running the trial balance for the year of 2021, the last year. Okay, just calculating balances. See, all these are the balances related to the current layer. When you see calculation here, you can see the posting layer selection as current. Other than this, you can also select any other layer here. Suppose if I select this one, tax layer, and calculate the balances here. See, I don't see any balances because I did not post anything into tax layer. You can use the same same asset number, sorry, the main account numbers are the same main accounts, and you can post transactions also. But for that, you have to create a separate journal name which is having the tax layer in it. So for all the journal names that we have seen, every journal name is having current layer. But in order to post transactions into any other layers, you have to create a journal name separately with that particular layer, say either operations layer, tax layer, or current layers. Any other layer you can select while you create a journal name and you can post transactions. But that was not a case in most of the businesses. Only for the sake of fixed assets, we use these layers called as these different layers other than current. So whatever you post into this particular layer, current act is the main act or the main fixed asset balances or the main impacts of fixed assets are posted into general ledger into current layer, which would affect the original books of accounts. The other books that we might create further will get posted into different layers other than current. Okay, that we would see now. Other than this posting layer, we have this concept allow net book value higher than acquisition cost. So it would be a parameter which would allow you to add more value to the fixed asset. Suppose today, if the asset is bought for 1 lakh, suppose the net book value of the asset is 1 lakh. Okay, next, after 2 or 3 months, if you are posting another 50,000 into the fixed asset, that would increase the net book value of the fixed asset from 1 lakh. Suppose. So either you can post such kind of acquisition adjustment or addition value which would increase the asset value or not is the parameter that is having here. Allow net book value higher than acquisition cost. So if you want to add anything additional to the fixed asset which would increase the asset value, so system will not allow you if you disable this parameter, which is if it is exceeding the original acquisition cost, it will not allow you. But if you enable this one, you can add any much of amount to the acquisition adjustment or to the fixed asset. You can increase the fixed asset value to any value if you want. You can make adjustments. Allow negative net book value. There won't be anything like negative net book value. You don't have a negative value for any fixed asset. But if it is a situation where the depreciation has to be represented and the net book value should be going to zero or less than zero, like negative number, you can allow this parameter, allow negative net book value. Otherwise, it's not required at all. Okay. Then you have one option here called as calendar. Generally, if I go to straight line service life method, any depreciation method, here we have selected depreciation year as calendar year, right? Calendar year means it will follow the regular January to December pattern, and on monthly basis it would calculate depreciation. Suppose if the dynamics want to follow your fiscal period, suppose if you might be having monthly calendars or weekly calendars or quarterly calendars or 445 calendar, anything. If you want to depreciate your fixed asset in that particular pattern only, then you can select fiscal here. Fiscal and according to yearly or fiscal period. Fiscal in the sense you can select yearly where it calculate the whole year depreciation, or you can select according to your fiscal periods. Again, you know, right? You can differentiate your fiscal periods or divide your fiscal periods according to your wish, maybe monthly or daily or weekly or fortnights, quarterly, anything. So according to your fiscal calendar and the fiscal periods that you have divided, if you want to calculate depreciation accordingly, you can calculate. And if you select fiscal calendar in the depreciation profile, you can select your own fiscal calendar here. Either you can select your fiscal calendar that is linked to this particular legal entity, or you can separately create another calendar for the maintenance of fixed assets. Few people also do that. They can separately create another calendar for the maintenance of fixed assets. See, in India, we normally follow the calendar of April 1st to March. Okay, so generally in an Indian company, the assets books are also closed at or anything in normally books and the year-end closure is done at the March 31st. Sometimes some people will maintain that for Companies Act it is March 31st, but for IT Act some people will represent or position their books according to the in January to December calendar, and they would represent their fixed asset balances to the tax act at 31st of December ending to any year. Some people would generally show them according to March 31st only. So in that case, they can create a separate calendar here on January to December basis, fiscal calendar separately. They can link it here, or they can, if they want to calculate quarterly depreciation, they can even create a calendar with quarterly periods here, and they can link it here in this particular book. Dynamics provides that feasibility. If not here, yeah, you can link it here only in this place, the calendar page. And if you don't want to link any separate calendar, if you want to maintain normal fiscal calendar on monthly, you can maintain it. So normal calendar, not fiscal calendar. So that's how this concept of derived books, let's come back to in a while. So this is how we can create a book under Companies Act. Now I'll create a new one. So I'll just name it as TA book, Tax Act book. Okay. Okay, perfect. Tax Act book. So in this book also I want to calculate depreciation. The whole purpose of maintaining books is to calculate depreciation, but in different style. So the depreciation profile that I select here is not straight line service life. Here I'll select reducing balance 20% or written down value method, what we would normally call in India. So I'm selecting this reducing balance 20% method. And you can give further same configurations, create depreciation adjustment, yes, but the most important is posting layer is not current layer. Posting layer is tax layer. Okay, this is very, very important. Posting layer is tax layer. Then you can allow net book value higher than, and you can leave this negative net book value concept. Okay. So just the same book or the kind of same rules, but different depreciation profile. So the why are you maintaining two different books is that you have to depreciate your fixed asset in two different ways or according to two different depreciation methods. So here in Companies Act, you have straight line service life method, whereas it comes to Tax Act, you are creating reducing balance 20% method or trying to depreciate your fixed asset according to the reducing balance method, which is according to the guidelines of Tax Act. But here, according to the guidelines of Companies Act, you are maintaining the same fixed asset with straight line service life method or straight line method, what we call. So that's the whole difference. And the main and important thing is that layer is different. So here for Companies Act, you have current layer. For Tax Act, you have tax layer, which is very important. And you can also create a third book if you want to. So I'll just create it as a, what can we say? Local gap, I'm saying, okay. So according to different gap IDs also, they'll maintain different books. Local gap book, I'm saying the depreciation profile which I'm giving here is 200% reducing balance method. Okay. And I am allowing to calculate depreciation. What I'm doing is I'm also allowing to create depreciation adjustments, but I'm not allowing it into post into general ledger. I don't want to post any transaction of this book into general ledger. That is the key thing. So I don't want to post any voucher for this into general ledger. So transaction will be posted for fixed asset, but not the voucher. So I just disable this and you see the posting layer is none, means it will not post into general ledger. And I'll enable this one if required. I'll remove this one from here. So this is how I can create multiple books and all of them come with the same kind of configurations, but the setup would be different little. The depreciation method would be different and posting layer would be different. So that's how we can create the books, Companies Act book, Tax Act book, or any other book which you can to post into general ledger into different layers, or if you don't want to post into general ledger at all, no posting layer. So this is the concept of books. There is one more small concept called as derived books, which is very important for the sake of interview as well. They will definitely ask you the question, what are derived books? So derived books is a concept which would be helpful for linking each other book. Suppose if I go to Companies Act, let's say if I'm posting any acquisition transaction in the Companies Act, so that will be posted only to this particular book, Companies Act book only. It will not affect the Tax Act book. You have to separately post a transaction again in the Tax Act book for the acquisition of fixed asset. The same way depreciation you have to post first in the Companies Act book, not first. You have to post it in the one book, then you have to post it separately in another book. But this particular page or this particular configuration derived books will help you to post the transactions automatically in the other book when you post it in this particular book. Suppose in the Companies Act book, I will link this Tax Act book. So I can see all the list of 3 books here. I am linking the Tax Act book. I am in the Companies Act book selection. In that, in the derived books, I am linking Tax Act book and I am linking the transaction type as acquisition. Which means if at all I am posting an acquisition entry using this particular book, Companies Act, automatically with the same amount, the acquisition entry will be posted to the Tax Act book as well. But this will be posted into current layer. This will be posted into tax layer. So automatically the acquisition transaction will be posted in the other layer as well. So in case if any transactions posted in this particular book also has to be posted into this book, then you can link both of them here. So which would decrease some work of dual entry. So I'll also link acquisition adjustment as well here. Whenever I
post any acquisition entry or acquisition adjustment entry into Companies Act book, automatically that will be posted into Tax Act book. But I don't want to link depreciation here. So if I would link depreciation here, then it would be wrong. Suppose if I link depreciation here, because here the depreciation method is different. Here the depreciation method is different. So both of them will be posting different depreciation values. So which means if I link both the books, the same depreciation value of the Companies Act will be posted into Tax Act, which is wrong. So depreciation has to be separately evaluated and separately posted. So that is not a interlinking transaction. But acquisition and acquisition adjustments are interlinking transactions, because in any book, the amount that you acquire of the fixed asset will not differ, right? Depreciation methods would differ, or depreciating value would differ, and net book value would differ at the end according to the amount of depreciation that you are depreciating on the fixed asset. But the acquisition value and the adjustment values of acquisition or write up, write downs will not differ. So you can link such kind of transactions like write ups and write downs if you want to. Like we have write up transactions, write up adjustments. Come on, here write up adjustment, Tax Act book, write down adjustment, something like this, or revaluations. You can link them. Whatever you do with this book also will be posted into this book, like that. Or you can also link this book as well. Here you can add the other book as well, local gap book. And you can also add same again local gap book, but this time with acquisition adjustment. Also you can add the local gap book with write up adjustment. Also you can add the local gap book with write down adjustment. So I'll just give you derived books and use it to link different fixed asset books to each other. So that's how derived books are used to interlink different fixed asset books to each other. When interlinked in different derived books, transactions posted in one book will be posted into other book automatically. So it would automatically create another transaction for the other book and post voucher for the other book as well, but into a different layer. That's the concept of derived books.